Would you say that investors should look at investing lump sum when market falls, or should they try to lean towards SIP more?
That money became 16 times in 2 years.
Personally, which mutual funds do you prefer?
My emergency money was keeping a 100 rupee note in Bhagavad Gita.
How do you narrow down to high quality mutual funds? What are the top 2 to 3 criteria that you would say?
There are funds, which I like very much, the mid-cap funds or the small-cap funds.
In mid-cap category, which is the top 3 mutual funds?
There's a new fund, the White Oak Mid-Cap. I like it very much. I invested a large sum of my money as well as my company's money 4 years back, and I never put it in public.
Where do you see Nifty by 2030?
I wish I knew. I won't be in the business of writing stories.
If you invest in mutual funds or stocks, it's unlikely that you haven't heard about value research. And guess what? I've managed to convince CEO and founder of Value Research, Mr. Dhirendra Kumar, to share with us his last 35 years of experience, investing experience, in just less than 1 hour. So in this episode, we are going to learn, number 1, how much money is enough for our financial independence. Number 2, Dhirendra Kumarji's favorite mutual funds that personally he invests in. Number 3, what is better, SIPs or buying the market dip? Number 4, how to go about investing in gold, which is the better instrument, and much more. And let me repeat, his 35 plus years of investing experience compressed into less than 1 hour. Subscribe to my channel now and switch on the notifications so you don't miss out on excellent content that is going to come your way. Enjoy this episode. Dhirenji, thank you so much for giving me your time. I'm a big fan of your simplicity. I don't know how you keep so simple, humble, grounded, and yet so knowledgeable. So what is the secret, sir?
No, I think, these are natural personality traits. I don't work hard towards that. I just conduct my business, or I conduct my very simple schedule. My investment principles are simple. Belief in basic simplicity, because it complicates. Maybe something would have contributed to it. Maybe being away from Bombay would have helped. Maybe I'm running a bootstrap business. Maybe it would have helped.
Right.
And feeling very happy and blessed that we are so lucky to be born at a time where most of our achievements, we can attribute it to the context.
Right.
It's not my achievement. Most of the things that we see today is because dematerialization happened, mutual funds happened, markets evolved, India opened up. So if you look at the evolution of the opening of the economy and the impact of that over the next 20, 30 years. So we really don't have much of a say in that. So you can't take credit for most of the things. It is the India tailwind, which is making things happen. And thank God for all that. Thank everything. I think, it helps to be modest about it.
Yeah, no, thank you so much, sir. You're being very, very humble. I want to start this conversation with your investing journey. So please tell us about your first investment. When was it? What was the amount? And how far have you come from that point, which was your first investment, to now? So give us a sense of how it's been for you.
My first investment wasn't mine. I persuaded my parents to invest in a mutual fund.
Right.
That was in the early days of mutual fund, sometime in August 1990. That is the year I was graduating.
Right.
In the year 1990. So I persuaded my parents to break their fixed deposit and invest in a mutual fund.
Right.
And that was quite a sum. That was a very meaningful sum for my family. And that money became 16 times in 2 years' time. 16x in 2 years' time. So that actually had the potential to get into my head. Positioning myself as a genius, and a lot of people thought so, simply because people don't look at the context. People just look at the results. If you have done it, would have been, some, but it was an accidental thing. What happened was in 1990, mutual funds were entirely in the public sector domain. SBI launched a fund called Magnum Multiplier Scheme 1990. And before that, there was only 3 equity funds in India, launched in India: Master Share, Can Share, and Can Growth. And this was the 4th one. So I had seen the Master Share, Can Share, and Can Growth, that they went up by 4-5 times by then. And in those days, mutual funds were launched there were only closed-end mutual funds. Fund companies used to launch a closed-end fund for it with a defined term. So I persuaded my parents that this is the fourth one and coming. And then and I had no inkling that what magic it is going to, or what transformational thing this action will be. What happened was we invested, persuaded my parents, helped some of my neighbors also invested. And then the Great Indian Scam happened in 1992. Markets went up. Markets went up from the levels of 800 points around that time to 4,000 points in 2 years' time. The Great Indian Scam, led by Harshad Mehta. And this was a mutual fund which went up by 16 times.
Right.
And it was entirely the short supply of it. Complete unawareness about it, no understanding of what a new net asset value is, what the market price is there a connection, why is it happening, what is going on, all kind of rumor mongering going on. And as a result of it was that this went up by 16 times. So first I was curious that we should invest. Then I was curious that why it has gone up. The result was discovering that the net asset value of this fund is only about 16-18 rupees. And people are crazy to be investing at, somebody has to lose money because the underlying worth of the investments is 16-18 rupees. At most, even if it goes up by 3 times, it will be 40-50 rupees. It is crazy to be doing that. So once I came to know of the NAV, I persuaded my parents to sell and realize the gains.
Brilliant. This is very, very fascinating to know that back in 1990s, you started and pursued your parents to invest. It's been 35 years almost now.
Yeah.
How's been your investing changed, over the course of 35 years? Are you still into mutual funds or have you diversified more? What have you learned and where have you invested in the last 35 years?
Not much has changed in terms of temperament. Of course, every day you learn things.
Right.
And I think the first 10 years where I did not have the understanding, I didn't have the depth of understanding, I was still trying to figure out. And I think if anybody claims that he has understood things in the first 10 years, he's lying. Simply because you have to really experience it. You have to see a 10% fall in a week's time.
Right.
And how you behave. And there are two things which is very important and which makes every investor unique. One is that how important is that money. I remember when I was working to develop value research or getting started with value research, my emergency money was keeping 100 rupee note in Bhagavad Gita.
Right.
That was my emergency fund. If you get stuck, you buy the ticket, get back home. Right. And those days, that was a 1,100 kilometer journey, which used to cost about 110 rupees. So that was to have this understanding. So what impact a scale of money has on you,
right,
only you know. That 100 rupees was very crucial to me. Likewise, when you see a 2% gain or loss in the market, that 2% gain or loss, has it really translated into wiping out your margin? That is a different story. Has it translated into, you have been investing for 15 years and your financial net worth is 28 lakh rupees. And then that has gone down by 2%. But 75% of that 8 lakh rupees is by way of gains. Right. You will not panic. So your experience, scale of money, and how it is connected to your real goals. If it is going to disrupt your child's education, you will worry. If 2008 happens, how do you behave? Is it going to really deprive you of some spending plans or some important goal, which will get destroyed or disrupted? You are bound to panic. So I think we are all slaves of our conditions.
Right.
And that I think is people understand less on that dimension. People always think that there is something external. Right. Markets will do something. US markets will do something. RBI will do something. Interest rates will happen or something else will happen. No, I think if you are able to configure yourself that what matters, what are you working for. Things are goal oriented. And if you spend a little bit in terms of understanding the character or the, equities are going to be like this only.
Right.
Are you investing or are you speculating?
Right.
Why things work the way they are? If you start with a general, set of questionnaire for your curiosity, and even if you don't have perfect answer, I think you will be able to build great foundation to be a long-term success.
Great. And I think you're talking about the long-term success and long-term investing. And you talked about the configuration of oneself, not looking at the market conditions maybe. I want to ask you, let's say if there is an investor, young investor, right, in 30s, and they have an aspiration that by 50, for example, they want to be financially free. So it's a 20 years of period that they're giving to themselves. How should they approach this 20 years? And specifically, I want to ask you, what's your view in terms of calculating that financial independence number, right? So let's say I'm 30 today. By 50, I want to be financially free. And looking into my own personal circumstances, how do I say that by 50, I need to have, 5 crores or 10 crores? How do I plan for that number?
This is a slightly complicated thing. It's arithmetic. It's not complicated. I would say that there is a thumb rule. Okay. The thumb rule is something about 300 to 500, 400 times. Say, just for clarity or ease of absorbing it, 350 times of your monthly expenditure.
Right.
In that days, your retirement, when you will be 50, how much money you will need every month? Right. How much money will you spend? For that, you need to really figure out, do some estimation of how much do you spend today and compound it with 6%. Right. If you are 30, compound it for another 20 years and how much will you need? Right. And that day's money, 350 times, things will be sorted. Right. And that how much money is entirely a function of what is your expenditure.
Really want?
What is your expenditure? Because many a times, if you have a lavish lifestyle and you want to really improve it even further, then that is why I'm referring to that day's expenditure. Right. When you turn 50. If you are able to curtail on things, that's a different story. Then there are many things which require customization. Right. For example, do you have a home? Do you have a health condition which will support that? Will it require some extra things? So that way you just might have to prepare with a 450 times than your monthly expenditure for extraordinary poor health, or those expenditure will go out of hand. It is better to be preparing for it beforehand than later figure out that it is not just good enough. Right. Or you just might fall short. Your home expenditure and those kind of things. So that is the ballpark thing. Think in terms of 350 times your monthly expenditure of the compounded, the worth of that at the time of your retirement, or at around 50.
Yeah. So take an example then. At 50, for example, if my monthly expenditure is going to be, let's say, 1 lakh rupee per month, then I am looking at 3 crores 50 lakhs if I do something.
A minimum of 350 crores. Because the simple rule is the 4% rule. Right. Okay. Assuming a 4% annual withdrawal from that, that is what it will translate into. And that should be invested wisely. That should be invested in a manner that it is beating inflation. Right. That should be invested, and you should be disciplined enough not to withdraw periodically. Right. It should be invested entirely into equity or substantially into equity till you are not realizing anything from it. It should be moderately invested in fixed income when you start realizing from it, so that you are not vulnerable to the market movement for your 100% of your money. Right. So you will have to worry about a couple of things, but they are not very complicated. Right.
Dhirendra, one thing that I personally observe right now is that because of the technology, there is a lot of free data and information available to all of us, which potentially was not there if you look at 10 years back. Now, there is an opportunity here that we could make sense of this data and make better investing decisions. For example, and I want to get your view on this, SIPs versus lump sum investing. This is a topic that we all are trying to explore. I've been exploring this for a long period of time now. Should you continue to do your SIPs? Or if you look at the data, you see that every year almost, intra-year, if you look at market, Sensex or Nifty, on an average, 15 to 20% fall is almost there consistently every single year. And this data we potentially never appreciated, but now it's out there in the public domain. Would you say that investors should look at, for example, investing lump sum when market falls, or should they try to lean towards SIP more? Because that's more discipline, that is more, you're not really reviewing much, you're just focusing on your active job income, and then you're just investing lump sum you're just doing SIP whenever you have the money. So, or is it the hybrid? Where do you draw the line in terms of investment? What's your view on SIP versus lump sum?
No, I think it's a meaningless debate.
Right.
Simply because, people are missing the point here. One is that you earn every month, you save every month. Why not invest every month?
Sure.
Most of our success entirely depends on the habits, and it's a great habit. And if you are investing for next 20, 30 years, there is evidence that if you bought at the high of the market every year, you'll still be substantially well off.
Right.
The whole problem is that, when you do a micro analysis of all these numbers, you try and find these excuses, and there is a big problem when you do this micro analysis. One is that it distracts you from this discipline and habit,
Sure.
which is so simple. The other is that if you ever succeed with this strategy, assuming that 1 year you remained in fixed income or kept the money in bank account every year, the whole year, to wait for that 52-week low on which you were able to invest. If you do it once, then you will try and attempt it many times.
Right.
And then you will get trapped. Markets are completely unpredictable. Markets are, it's very difficult that whether the next 3 years, next 5 years, markets will struggle. People are losing patience in what has happened since September 2024. It is hardly a time to lose patience.
Right.
In fact, if anybody who is investing for next 20 years should be feeling very happy that the market is not going anywhere, that you are able to buy cheap.
Yeah.
You are able, and just make sure that you are buying high quality funds, high quality companies, which will not die, which will survive, which will thrive, which will go on to become a leading company. If you have the understanding, knowledge, inclination, and belief in few companies, by all means, go ahead and do it. Keep an eye on it and go ahead and do it. And follow the basic tenets. Diversify, allocate well. But it is extremely difficult. When I look, and I'll just cite you another example, that 1994 HDFC Bank went public. And since then, it has been among the top 5 best performing leading stock in the Indian stock market, the biggest driver. And then now HDFC and HDFC Bank merging and becomes a sizable entity, a powerhouse in our leading indices. And if you look at it, 4 times in these last 25, 30 years, it has gone down by 50%.
Right.
And when it went down by 50%, the doomsday proponents were so strong, or the opinion was so strong, that it was nearly impossible for anybody to invest then.
Right.
That now this is over, the game is over, the game is up. And so my understanding is that keep an eye on quality and don't try to time it.
Right.
It's a loser's game. Right. And you will be losing the biggest opportunity in looking for that tactical location to buy.
Right. Right. So you talked about high quality funds and high quality companies. Yeah. I want to understand what is your definition of high quality mutual funds? There are right now, even if you go to value research, you'll see thousands of mutual funds now. How do you narrow down to high quality mutual funds? What are the top 2 to 3 criteria that you would say?
3-4 things. One is that I am able to form an opinion about the quality only after looking at the performance for 3 to 5 years.
Sure.
Before that. And in 3 to 5 years, you are able to catch many occasions when the market would have gone down and you would have seen that how the portfolio was built. Then what is the thinking which is driving the opinion, driving the portfolio construction? What is the thought process? Because that thought process does not translate into outstanding result in the short run. But that thought process you are able to absorb. And third thing is validating that thought process. A lot of people are nowadays very articulate in explaining a theory which looks very impressive. Does it really add up?
Right.
Does it really get proven or demonstrated in the portfolio as well? And then fourth is making sure that the guy who is actually saying it and doing it is still there. And fifth is the incentive mechanism. The people who are working there, are they aligned with the, whether they have invested their own money? Do the company where they work incentivizing them for short-term performance or long-term performance? If you actually incentivize somebody for doing well next 1 year, he will do exactly that, and the year after that there'll be something which will blow up because that was all his KRA. These are all so understanding the thinking, and in the process, understanding the guy who is running it, because his experience, his foresight, his knowledge, has a great influence on how he thinks. Many a times you come across and how practical he is, because everything in the market changes radically. The narrative that you come across, and a year from now it will change. So these are the 5 things which guides our framework.
Right.
And this is something which I feel very proud of, that, now I have, it took many years for us to understand this,
right.
To articulate this. And now I have a team of, fund analysts who are at it day in and day out. And we talk to many fund managers, and we take note of his answer. And then we talk to the same fund manager, take note of his answer 6 months from now, again 6 months from now, from there on. And then we compare it. That has he been saying things which are consistent?
Right.
That brings about great clarity in our mind, what he believes. And I think that has worked out very nicely for us.
Right. Great. Personally, which mutual funds do you prefer? I know because you're deep into value research work that you see. You talk to fund managers. Have you made anything that is favorite for you in terms of mutual funds?
Oh, quite a few. In fact, I have a set of principles which are very important.
Right.
And when I come across an investor, and normally he's asking me, let me just demonstrate it to you with an example for you. Assuming that you come and tell me that you have to invest 1 lakh of rupees every month.
Sure.
And this 1 lakh rupee is very important.
Absolutely.
You are going to bank on this 1 lakh rupee for your retirement.
Right.
It can also well be responsible for your child's education.
Sure.
So these are 2 non-negotiable important goals. And if you're going to invest 1 lakh rupees, there are 2 ways I would like to, in fact, there are 3 ways I would like to approach this portfolio. Had you been 40-year-old, I would say that start your SIP in a balanced advantage or a hybrid fund, simply because you have never invested before.
Sure.
And you have crossed that basic threshold age where when you are in your 20s and 30s, you are very confident of yourself. That is a function of age, that you're in that, okay, something happens, I'll take care of it.
Right.
I still have my lifetime ahead. When you approach 40, then you get a little worried about it. And so that is why this hybrid. Right. Because it will fall less and it will not unnerve you.
Right.
And it is very important for any investor to develop a belief that he can stay the course.
Right.
So that's one. Second is that if it is for you, then I have 2-3 ways of approaching it. One is that I will start with a disclaimer that you are doing it and doing it for next 30 years, not getting tempted beforehand. 3 ways. One is that you can well start with a small cap and a mid cap fund and do nothing.
Right.
Just be at it and make sure that you're doing your SIP. Forget about multi-cap, forget about flexi-cap, because you are 30.
Right.
So I would like you to do this only if you have been, you have seen the turbulence and you have the confidence of doing it. But this could be a slightly riskier way of achieving it. Second is that a methodical one.
Right.
A plan which will take care of itself. The underlying things will change and you won't have to do any maintenance in between. And you can carry on with a plan and it can remain like that for next 20, 30 years, which is 40% of your money invested in an index fund,
right,
in a BSE 100 fund. Ideally, if there is a BSE 100 fund, which is getting you exposure to top 100 stocks, or a Nifty or a junior Nifty will get you the same. If you get half of your money in the equal weighted index,
right,
because our index funds are cap weighted and where the largest holding dominates the performance. So I look at equal weighted index as a slightly value variant
Sure.
of the, and I look at the normal index as a growth variant, growth style, and this. So if 40-50% is invested there and 40-50% is invested here, this fine for 50-60% of your money. Rest of the money invest in one or two multi-cap fund, and you are sorted. And for first 5 years, don't worry about asset allocation. Asset allocation is like buying an insurance, is like getting the shock absorber.
Right.
And you don't have to lose anything till what do you lose till you build something?
Sure.
And after you have done your SIP for first 5 years, then think in terms of getting that fixed income allocation is crucial.
Dhirendra, let me be slightly cheeky. I know you talked about somebody who is in 30s should look at mid caps and small cap. Let me be slightly cheekier and ask you, I don't know whether you're allowed to say the names or not, but I still want to try it out. Let's say in mid cap category, which is the top 3 mutual funds, or if you can give me top 3 that you personally like, and there is a reason for it, because I think even within mid cap, I see there are 15-20 mutual funds, or even more than that.
No, in fact, we have a service.
Right.
And I would like to reveal the names. And with mutual fund, there is a one advantage that even if I reveal the names, I can't influence the price of those mutual funds.
Sure.
When I tell the name, then I have to comply with a certain norms that I may not be holding it, or I have to give you a disclaimer that I hold these stocks for how long, or I plan to buy these stocks. In case of mutual funds, there are funds, which I like very much, the mid cap funds or the small cap funds. For example, the Bandhan small cap.
Right.
It has been an outstanding fund. Likewise, on the quality front, the Axis small cap.
Right.
There's a relatively new fund, the White Oak mid cap.
Right.
I like it very much, and I like it even though it is not 3-year-old. I look at their framework. I look at their selection. At Value Research, we have a technological backing of a technology team and a very, very intense work that has gone into it over the last 15-20 years. Is that when a fund does well, we try to dissect in two component, whether it is luck,
right,
or whether it is design.
Okay.
And what is the replicability of it?
Right.
The principles or the rules being followed, or which is reflected in the portfolio construction.
Right.
Is it something which can be repeated? And if it can be repeated, and we try and get a sense of it. Okay. And that actually points us that there are 6-8 funds here which are able to do exceptional job by their selectivity. They are not lucky.
Right.
In good markets, everybody does well. In bad markets, they are able to withstand better.
Right.
And then they are very well poised by following their same principles to participate in the next boom. And that is very important for an individual investor. Choosing your funds carefully, the ones which look exciting.
Right.
They will not be exciting. Will you be able to stick? Because if you look at all the small cap funds, 2008, the market went down. The market went down from its peak on January 17th of 2008 to sometime in October, went down by 45% on Nifty.
Right.
But the small caps went down by 85%.
Oh my God, I can't remember the data.
And some of the small cap funds, and there were some, in fact, there was one micro cap fund devised. It went down by nearly 87%. Assuming you invested 100 rupees and you saw the NAV at 1 rupee 30 paisa.
Right.
You'll be bleeding. You'll be crying. And that is why it is important to understand that, take a holistic view, take a long-term view, understand the process. And that's my worry to an extent in recent past. Last 3-4 years, a lot of people have a very exaggerated expectation from the market. They have far greater belief. And that belief in the long term is very well placed. I'm very confident that markets will do very well and they will not be disappointed. But for the first time investor, will they be able to withstand a 60% decline from their peak value?
Right.
Assuming your investment worth is, say, 1 crore of rupees, and you go on a holiday, come back after 3 weeks, and then you see that, okay, my investment is just worth 40 lakh rupees today. Will you lose your mind? Will you feel happy about it? Can you really carry on with your investments? Will you not, if you are not dependent on the market for your day-to-day living, can you still sustain yourself? How will you make yourself understand?
Right.
Do you have enough checks and balances? Do you have the, what is there in your portfolio which will give you the confidence that yes, you have, you will be able to tide over. This will pass as well.
Yeah.
How do you go about doing it?
I think between September 2024 to March 2025, I think that was a very good trailer, before the picture, where a few small cap funds, I remember, I don't want to name them, but went down by, let's say, 25%. This correction was a very good correction, not from losing the money or gaining the money perspective, but for me to experience that fall. Right? Because it's not happened post-COVID. 2020 ke baad mein, it's never happened, right? So in the 5 years of period when we saw massive bull run overall structurally, when all of a sudden your mutual funds fell by 25%, 26%, there is a realization, there is an experience here, which I think makes a lot of sense that you're talking about that, returns is one thing, but can you stay the course for investment?
Staying
that is the important
is critical.
thing. Yeah. Dhirenji, now I want to move to gold as well. I just want to get your perspective on gold. Last 3 years or 2 years, we've seen a mega rally in gold. I want to discuss with you, when I want to invest in gold, for example, there are various routes, right? We can go gold mutual funds, gold ETFs, physical gold is there. Which one is your favorite route out of these, and what are the implications that you want to share about gold?
My favorite route is something which you did not list, which was the sovereign gold bonds.
Okay, right. Of course, it's no longer available. That's the reason.
Yeah, it's no longer available, but in a way it is available.
Absolutely.
That you can buy it from the market.
Secondary market.
Secondary market.
Yeah.
And the advantage of sovereign gold bonds is that it earns you 2.5% more than the price of gold. And in all these forms, all other forms, you have huge penalty. You buy jewelry and you are basically buying something worth 80 rupees for 100. Making charges and impurity or the quality of impurity. Second is that, if you take a gold bar or, compromise on liquidity, gold bar, coin or whatever, the closest to pure form, that also has a holding cost and the liquidity bit might be compromised. When it comes to, so the next best thing is to actually, if you want to take a bet on gold or have an allocation to gold, sovereign gold bonds, and make sure that you are buying it from the secondary market in a manner which is not any extreme premium to its underlying value. That's one. You need to be very careful about that because now the supply has come to a halt. Second is that gold ETF. If you have a brokerage account, you can buy it from the market. Here too, you have to be careful. This is the next best thing which you can have. And look at the fund which has the lowest expense ratio and look at the fund. And there are funds which are trading, which are very efficiently, finely priced every day. And you can buy it. And realization is high and they are able to almost perfectly match the gold prices. So without the hassles of any of the other, holding it, buying it, purity and this concern, that concern, this is the lowest cost form of holding it. Third is, if you don't have a if you don't have an account with a stockbroker, maybe the sovereign gold, not the gold funds.
Yeah.
These gold funds are like open-end funds. The difference between the ETF and the gold fund is that here you buy it from the stockbroker like a stock at today's price, and you have to see that the price is very much aligned with or anchored to the NAV, not more than maybe 25 basis point.
Right.
Here you have to make sure that here, end of the day pricing, convenience. You can sell it anytime, buy it anytime, and you buy and sell it just the way market does, just the way you buy or sell mutual fund. Convenient. I think gold ETF is a very promising way of holding it, but you need a brokerage account.
Dhirenji, this was powerful discussion that we have had so far. I think there are so many good points. I liked the approach that you've talked about in terms of long-term investing, trying to not overcomplicate things, just simplicity, discipline, look for the quality. I think these are some of the nuances that I picked up from this conversation. I want to quickly move to the rapid fire round.
Sure.
And just ask you a few questions and see if I can, take out some more wisdom from you and be, better from where I am now. So the first one, it's slightly personal. What has been the biggest expense so far that you have spent money on?
My biggest, what looked like in expenditure has all turned out to be investment. So my biggest investment expenditure was, in value research, and it has turned out to be a great investment. Then books.
Books, okay.
And last 5-7 years, ever since I have been able to build an organization where I'm working hard, not successfully able to, but able to step back from too much of day-to-day activity and more about mentoring these many people.
Right.
Then gardening.
Right.
I have a fantastic, garden,
right,
which I nurture.
That's really great to know. Which is your favorite mutual fund, if you're allowed to reveal?
I'm not being diplomatic, but I'll list 3-4 funds which I have or people in my family have. I like the ICICI Prudential Value Fund. I quite like the Parag Parikh Fund, where there is a long-term investment, gradual investment happening from many people in my family. Another one is HDFC FlexiCap, which has been one of the oldest investment. In fact, I have a great story around here. I started investing for my daughter's education when she was born, and it's a very small sum of money. And that small sum of money invested over such a long period of time. And after 8-10 years, I forgot. And last year, she went to US for her education, and it is completely covered from that accumulation. And she also became an adult, so she is doing it from her own money, accumulated, contributed by me on her adulthood. And there is one investment which has done exceedingly well for us for the last 3-4 years, but that is an investment which I would not, nobody watching us or listening to me should follow that. It's an extremely risky investment. It goes up and down by 2%. I invested a large sum of my money as well as my company's money 4 years back, and I never put it in public. Because I thought because my risk tolerance was high, I had a far greater understanding. I was willing to absorb that volatility, which is that sizable money invested in FANG Plus.
Right.
Mere Asset, New York Stock Exchange, FANG Plus. We have been extremely lucky, and we took that chance, and we are still optimistic, and we are holding it for the long term. And this is a fund, this is an index fund of 10 stocks. Which dominate the technology horizon today, and it is extremely volatile. And it has proved to be extremely rewarding. So
these are the 4 funds
these are 4 funds which dominate our mutual fund portfolio.
Right.
Me and my family.
Sure. Can I just ask you, Parag Parikh, which one was it? You said Parag Parikh?
Yeah, the Parag Parikh FlexiCap fund.
Yeah,
that's the only fund they had.
Right. Okay.
That is the only fund they had.
That is the most talked about fund even on the YouTube channel.
Yeah.
And I think people love it for its simplicity, and more importantly, the downtime that we saw between September to March. This was the one fund that did not really fall a lot.
It just might be lucky, and some of those lucky streaks might get marginalized. But I think what is admirable about Parag Parikh is the thought process.
Right.
The thinking that guides the fund will remain there.
Right.
And so they will always be focused on valuation.
Mm-hmm.
They will always be focused on growth, but always be conscious of valuations. They are unlikely to be lucky in recent future to be investing abroad.
Right.
That turned out to be a great safety net for them. Mm-hmm. And because on one hand, these investments, it's almost like having a small part of FANG Plus in Parag Parikh. Right. Besides that, FANG Plus and Parag Parikh's foreign allocation also works in another way. The rupee depreciates.
Of course.
And the dollar assets appreciate. So that also has a contribution. So you may not be lucky like that all the time, but you can be assured of the process, which is conscious, or being conscious of the valuation and focused on growth.
Let me also congratulate on your HDFC FlexiCap story. I think it's an important story that I want even the viewers to know, that I've not met many people who had a goal when they started their investment, something like kids' education, right? Mm-hmm. When your kid is born, you put some money in there and you remain invested until you hit the goal. I think There are very few people. So
I'll give you a nasty story, which is the good news and the bad news. The good news is that I was able to initiate a 2,500 rupee SIP for her soon after she was born. And it carried on for a couple of years.
Right.
And then I forgot to give that, because in those days you had to give the standing instruction for 12 months, 24 months, 36
so every
months.
year it's a renewal.
So after 3 years it stopped. And then I realized after a couple of years that, this is a myth. So then I started a large sum of money, 25,000 rupees invested for the next 2 years again.
Okay.
But then what happened? And for that, I put that money in her bank account so that I will compensate for the period for which I have missed. And then what happened was I gave a standing instruction of that SIP. That mandate was set, and the mutual fund kept hitting that bank account and taking that money out. And the unfortunate thing is that the bank was so unusual in its misbehavior, or their systems didn't work, that after the money was exhausted, a couple of times the mandate hit and they closed the bank account. So the unfortunate thing was that, I could not reinitiate it, and the lethargy and the inertia. And but despite that, something being erratic, but done with that discipline and kept for 15, 20, nearly 20 years, has done the magic.
Yeah. And I think she's very lucky to have you, because
I hope that they carry these habits, or they pick these habits.
Right, absolutely. Brilliant. Thank you for that. Who is your favorite investor that you look up to? I know we've talked about Charlie and Warren, but is there anybody else?
One of the finest fund managers I've come across is Terry Smith. I adore him. I admire him, and I really like his principles. I recommend, I have made it a mandatory reading, his book, Growth Stocks, as for every stock analyst as well as fund analyst.
I'll definitely look out for that. Next one, Dhirenji, Indian wedding expenses. Do you think they are waste of money, or, it has emotional values?
Great for hearts, but it's bad for balance sheet. But do it, if it is not going to really damage your balance sheet, by all means spend as much as you like, or as much as you feel happy about. But if it's going to impair your balance sheet, don't.
What's the biggest secret of this equity market as per you?
Patience. And in fact, I get rewarded for patience. And that reward is coming from the stupidity of the impatient.
Somebody is selling and then you buying.
No, people are simply impatient, and that is by their design. They are putting their short-term money. They are speculating. They are not thinking long-terms, and they are caught unaware. They came with the wrong expectation. So his impatience is driven by many things.
Right.
It could be greed, fear, whatever. My patience comes from my configuration. So if you meditate about investments, I think you'll be able to fix most of your problem.
Where do you see Nifty by 2030? We still have 5 years to go almost.
I wish I knew. I would be the business of writing stories.
Which market fall scared you the most, if it scared you at all?
It did. Market falls of a severe kind is very scary.
Mm-hmm.
And I was scared out initially in my career when 2000... the dot-com crash.
Right. Okay.
That was the time when I did not have a sizable investment. 2008 was a very severe one.
Mm-hmm.
I was able to cash out from some of my investment at the worst of times.
Right.
And that is why I can relate to the anxieties of investors much better.
Mm-hmm.
I can understand the behavioral configurations, have far greater appreciation. And only with hindsight, you think that, it was a low. Hindsight is perfect, but when you are in the middle of a bubble, we just might be in the middle of a bubble for gold,
right?
But you don't know till it is burst. You get to know about the burst or the bubble only with hindsight,
right? Absolutely.
So 2008 crisis, I was scared out of the market for half of my equity fund holdings. And in 2002-03, I just lost. I did not lose money in 2002 or 2001, so to be precise. But some of my technology funds went down in value by about 40% from its peak. And I was very regretful.
What's that one advice that you will give to couples in today's context when it comes to financial investments?
I really don't have an advice, but I would just suggest that they plan jointly,
Right.
so that you have joint responsibility and joint ownership of the outcomes. Because most of the time the problem is lack of appreciation of the way I am thinking, and if my spouse is not aware of it, the what is guiding my thinking, then we will have friction, and we will have contrary expectation. If we are aligned and being partners, I think one should be aligned and make sure that you have a sizable emergency fund.
If you were to go to dinner with a celebrity, who would that be?
I don't really aspire to be, but still, I just for the, I think, I'll still like to enjoy a dinner with Mr. Buffett,
Right. Okay.
who is still alive.
Yeah, absolutely. Still
And-
strong and still going.
Yeah.
If time and money was not a limitation, where would you go for a holiday?
I don't have I normally like a quiet place, and I have a
Right.
place. I've got a place done where I normally head without much of a thinking.
Right.
I need a predictable place. I'm not a traveler for kind whereby I'm looking for new experiences every day. This is a place where I go on the hills and in the Himalayas, and it's a quiet place, and you can live without the connectivity and essential comfort, basic comfort to live there.
Brilliant. Thank you so much. I think this was all power packed. There's a lot of time that we've spent in this conversation, Dhirenji. I've learned a lot of things from you. The energy sitting right next to you is quite that I can't explain in the words. So thank you so much for
Thank
having
you
this
very much.
conversation.
But getting back to primary thing, 350 times your monthly expenditure on retirement.
That's the target. That's what we
that's
need
the
to keep
target,
the framework in mind. With that, I hope you thoroughly enjoyed this. If you did, leave a like and let me know in the comments who should be my next guest. Looking forward to have you on my next one. With that, keep rocking.